Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Understanding CDOs, a guide to risks, returns, and market impact. CDO creation process. Creating a CDO is an intricate process. Here's a step-by-step look. Pooling assets. The process starts with gathering different debts. Banks collect loans, bonds, and other financial assets to form a pool. Think of it like gathering ingredients for a complex recipe. Structuring the CDO. Once pooled, the assets are structured into tranches. Each tranche is designed to appeal to different investors. This step defines the risk and return of each slice. Issuing securities. After structuring, the CDO is ready to be marketed. Securities are issued to investors through a special purpose vehicle, SPV. The SPV acts like a safety net, isolating the investment from other financial activities. Selling to investors. Financial institutions handle marketing. They present the benefits and risks to potential buyers. Each investor picks the tranche that matches their investment goals. This method allows banks to manage and spread risk. Investors gain diversified exposure to various debt instruments. Understanding each step gives insight into why CDOs are significant in the financial market. Risks and benefits of CDOs. Collateralized debt obligations, CDOs, offer a mix of risks and rewards for investors. While they can potentially deliver attractive returns, they also bring substantial risks that need to be carefully considered. Let's explore these dynamics in more detail. Credit risk and market risk. Investing in CDOs involves navigating complex risks, primarily credit risk and market risk. Understanding these can help investors make informed decisions. Credit risk. This is the risk of borrowers defaulting on the underlying debts. If enough borrowers fail to repay their loans, the CDO's value can decline. Investors in junior tranches are especially vulnerable, as they absorb losses first. Market risk. Changes in the broader financial market can impact CDO values. Factors like interest rate fluctuations, economic downturns, or changes in investor sentiment can alter the valuation of CDOs. Market risk is inherent in all investments, but CDOs can be particularly sensitive due to their complexity. Both credit and market risks require thorough assessment before investing. It's crucial to understand the underlying assets and macroeconomic conditions affecting their performance. This analysis helps investors identify which tranches may align best with their risk tolerance. Potential returns. Despite the risks, CDOs can offer compelling financial benefits compared to other investments. Here's why some investors are drawn to them. Higher yields. Junior tranches of CDOs offer the potential for higher returns as compensation for greater risk. These can surpass the yields of traditional bonds or other securities, appealing to risk-seeking investors. Diversification. CDOs bundle various assets, spreading risk across different debt types. This diversification can stabilize returns over time, balancing high-risk tranches with more secure ones. Customization. CDOs provide investment flexibility through their tiered risk structure. Investors can choose tranches that fit their risk appetite and return expectations, similar to customizing a portfolio. While high returns are tempting, it's vital to balance them with the potential for loss. By understanding both the opportunities and risks, investors can make strategic choices that align with their financial goals. The impact of the 2008 financial crisis on CDOs. The 2008 financial crisis was a thunderclap that shook the financial world to its core. At the heart of this turmoil were complex financial instruments like collateralized debt obligations, CDOs. These instruments, once hailed for their ability to spread risk, became symbols of financial fragility. To grasp why CDOs played such a central role, we need to look at their entanglement with mortgage-backed securities and the sweeping regulatory changes that followed. CDOs and mortgage-backed securities. During the 2008 crisis, CDOs were tightly linked to mortgage-backed securities, creating a web of risk that few foresaw. Here's how they were connected. Integration with mortgages. Many CDOs were filled with mortgage-backed securities, especially through subprime mortgages. This mix promised high returns but masked the growing risk of borrower defaults. Illusions of diversification. CDOs were believed to spread out risk by pooling various assets. However, as mortgage defaults soared, the underlying assumptions crumbled, revealing that many CDOs were stuffed with similar types of risky debt. Chain reaction. As homeowners began defaulting on their mortgages, the value of mortgage-backed securities plummeted. This, in turn, devalued the CDOs containing those securities, leading to widespread losses across financial markets. In essence, CDOs amplified the housing market's risks, spreading their impact far and wide. This entwinement showcased the dangers of relying on financial products perceived to be low risk without thorough scrutiny. Regulatory changes post-crisis. In the wake of the crisis, the financial world saw a seismic shift in regulation aimed at preventing a repeat. These regulations specifically targeted the practices surrounding CDO creation and sale. Dodd-Frank Act. This landmark legislation was introduced to tighten financial regulation, addressing issues like transparency and accountability. It required greater clarity in the marketing of CDOs and enhanced oversight of credit rating agencies. Volcker Rule. Part of the Dodd-Frank Act, the Volcker Rule aimed to restrict banks from making certain kinds of speculative investments, including those involving CDOs. This rule sought to prevent banks from taking excessive risks with depositor funds. Improved transparency. Regulators demanded more transparency in the structuring of CDOs. This included better disclosure of the assets in CDO pools and the risk associated with each tranche, helping investors make informed decisions. These changes aimed to mend the flaws that allowed CDOs to become ticking time bombs. By imposing stricter regulations and ensuring greater transparency, the hope was to restore faith in financial markets and safeguard against future meltdowns. Future of CDOs in the financial market. Collateralized debt obligations, CDOs, continue to captivate financial markets. Their evolution in a post-crisis world reflects both caution and innovation. Let's explore the trends and outlook shaping their journey. Emerging trends and technologies. Technology is reshaping CDOs, influencing how they're structured and traded. Here are some key trends. Blockchain integration. Blockchain technology is bringing transparency to the financial world. By using blockchain, CDOs could soon see clearer, more secure transactions. This tech allows for near instantaneous settlements, which reduces counterparty risk and enhances trust. AI and data analytics. Artificial intelligence is also making waves. By harnessing AI, firms can better predict defaults and manage risks. Advanced data analytics provide insights into borrower behavior and market conditions, allowing investors to make informed decisions. Smart contracts. These digital contracts automatically execute actions based on predefined criteria. For CDOs, smart contracts could streamline payments and trigger alerts, ensuring smoother operations and minimizing human error. These technological advancements are not just fancy features, they're slowly becoming integral to the evolution of CDOs. The integration promises a blend of efficiency and security, making CDOs potentially more robust. Market outlook. Analysts are cautiously optimistic about the future of CDOs. Here's what they anticipate. Diversification opportunities. CDOs still hold appeal due to their diversification potential. With careful management, these instruments can offer attractive returns across various economic conditions. Regulatory environment. While regulations have tightened, they also provide a clearer framework for operation. This can instill investor confidence, knowing that there's oversight ensuring better practices. Increased demand for ESG compliance. Investors increasingly prioritize environmental, social, and governance (ESG) factors. The push for ESG-compliant investments could shape the types of assets included in new CDOs. Potential for growth in emerging markets. Emerging markets are ripe with opportunities for CDOs. As these economies grow, there's a demand for more sophisticated financial products to manage debt and investment. The future isn't without its challenges. Economic volatility and interest rate shifts pose real risks. However, the adaptability of CDOs, coupled with technological and regulatory advancements, makes them compelling for diversification and potential growth. What's your take on the future of CDOs? Could these changes lead to a resurgence, or have risk-averse strategies taken the wheel? Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.